Hello, everyone. I am Michael Muirhead, and I lead the Learning and Development team at Broadridge Fi360 Solutions. I am really excited about our IAA session today, which is focused on information and insights that we have collected as part of our firm level assessments on investment advisory firms. You may have been familiar with uh, past Broadridge presentations that have focused on class action and/or proxy services. This year, we wanted to introduce you to a new Broadridge business line. Fi360 was acquired by Broadridge in November of 2019, and we believe that it really aligns nicely with our company's focus on industry-leading governance solutions. So today's session will cover three main topics. First, I wanted to give you some background and context on why and how we have developed standards of practice to support our assessments. Next, I wanted to cover some of the key insights, observations, and trends that we've collected as part of our assessments. And then third, I wanted to end with some thoughts on how we are able to help IAA members. I will try to address questions as they are submitted throughout the session, but I'll be sure to leave some information or some time at the end to address any open questions. So let's begin with some background on Broadridge Fi360 Solutions and our assessment process. So why did we create a standard for fiduciaries? It all started with our mission from the very beginning over 20 years ago. We believe that financial intermediaries and stakeholders should use prudent or fiduciary practices to profitably gather, grow, and protect investor assets. So that was the why, that was our mission. So how did we go about constructing these standards of practice that are part of our prudent practices? We started with reviewing and studying the major laws in the United States that we're showing here on the screen, which are the primary source of fiduciary requirements across different types of portfolios. As you all know, this isn't an exhaustive list. There are a number of other federal laws that cover different types of portfolios or service providers that supplement these laws that you're showing on the screen, as well as additional state laws. Layered on top of these laws are associated regulations and court decisions and oversight regimes that enforce laws such as the SEC, DOL, state attorney generals, FINRA, et cetera. But we believe that this is where sort of the fiduciary standard is defined and compliance comes from, and that there are core duties that run across these different types of oversight structures. So across the various laws and regulations that I just discussed, there are principles or precepts in common that are really at the heart of prudent investment management. These principles are consistent with other parts of the world where they have legislation around investment practices. Broadridge Fi360 has coined the term global fiduciary precepts to denote three key principles or precepts that we have identified. Again, that goes across the spectrum here, and we've outlined them here on this particular page. So first and foremost, it's following laws and governing documents, um, diversifying portfolios to manage for risk and return, making sure that there is a documented investment policy statement or strategy or plan, prudently selecting fiduciary and non-fiduciary providers, making sure that there is mechanisms in place for controlling and accounting for all expenses and costs related to these client portfolios. If you can't avoid conflicts of interest, that you're at least disclosing and trying to manage and mitigate those conflicts, that you're monitoring service providers, and last, that you have some type of organizational structure for monitoring and assuring conformity to these really important fiduciary obligations. So from those prudent or global fiduciary precepts, we developed 21 practices and 79 criteria that are organized in a four-step process that we call the fiduciary quality management process. And the steps that you see in the center of this graphic here are consistent with global ISO 9000 quality management system standards, which really emphasize sort of this notion of continual improvement around your decision-making process. And I'll just give you a little bit of a highlight around the four steps. So step one is organizing around the client engagement, making sure that you have all of the relevant information that is related to that particular client situation. The second step is around formalizing the overall investment strategy or plan, creating a structure for an investment policy statement when it makes sense and is applicable for the specific client situation. Third step is implementing some type of investment or service provider due diligence process, and in some instances, taking into consideration safe harbors that may be applicable for the client relationship. And then the last step, the fourth step, is monitoring and creating some type of ongoing governance structure in order to make sure that the client's objectives and constraints are being met. So we took that information and we published 3 handbooks that you're seeing here that are defining the standards of practice for investment stewards. And we define investment stewards as, plan sponsors, investment committees, retirement boards. They would all kind of fit in that stewards audience. We created standards for investment advisors and managers, and we published them in these 3 handbooks. So within the handbooks, each practice is laid out as you see on the screen. So we define the practice. So in this case, we're looking at practice 1.1, and underneath the practice, you'll see the criteria that provides further details around application of the practice. We usually include some type of narrative, but one of the things that we really emphasize is that there is a section that supports each of these practices and criteria, which is the substantiation practice. And that's where we lay out any of the regulation or legal references that support the basis for that particular standard and criteria. This all leads us to practice 4.5, which recommends a process for reviewing how effective at the organizational level um, these organizations are at meeting their fiduciary responsibilities. And key to or the criteria for helping meet that practice is 4.5.1, which is fiduciary assessments or independent, fiduciary audits. And this is the service that the Center for Fiduciary Excellence, or CEFEX, performs or provides for the industry. And this is where we were able to gather a lot of the information that I'll be sharing here in the next section. So again, just wanted to give you a little bit of context and background around CFEX and the standards that I will be referencing throughout the rest of the session. As you can imagine, fiduciary assessments produce a ton of data and information and insights, and that's really what we wanted to do for the bulk of the session, is share some of those interesting insights, observations, and trends. So let's talk a little bit around where the specific data comes from for this particular section. So at CFEX, on an annual basis, we would create what we call the assessment data report. And we share this report with our CFEX certified firms to really help them benchmark their practice operations, provide some insights around what's going on from a trends perspective. And this information that we provide in the reports are based on the hundreds of assessments that we do on an annual basis. And the thing to note is that these assessments are based not only on the handbooks that I mentioned earlier, but we also have a number of non-published standards that we maintain as well. For example, we have a standard for retirement plan service providers, and they would include, entities like record keepers or third-party administrators. We provide print practices for investment support organizations. These would be, for example, home offices that are responsible for managing a number of investment advisors or a number of agents, and provide oversight of their retirement and wealth management advisory business, as well as investment technologies and tools. And so, in terms of investment advisory firms, the report that this information comes from was published in February of 2020 and includes assessments or information from assessments of roughly 140 firms. One of the things that I want to emphasize here that's really important is the individual firm data is never distributed or and remains confidential throughout the information that I'll be referencing. So this particular slide provides you some information on the advisory business models that are represented as part of the information that I'll be covering. So as you can see, about 45% or a little less than half are from fee-only advisory firms. About 39% come from firms that are independent firms, but also do some insurance business. just about 1/5 or 21% are duly registered firms that can, collect both commission and fees, and about 6% are made up of bank or broker affiliated or organizations. This next slide gives you a little bit of a sense of the book of business of these CEFEX certified firms. As you can see, it's a pretty substantial group of clients that these advisory firms are representing, both retirement and non-retirement accounts. As you can see, a really nice cross section of different types of retirement programs, everything from defined benefit plans to Taft-Hartley to 403b plans. Roughly 22,000 plans are covered by these advisory firms, representing 277 billion in assets under advisement, and an average client size of 13 million. On the non-retirement accounts side, you can see eleemosynary accounts, endowments, foundations, private trust, net worth accounts, roughly 53,000 accounts representing 66 billion in assets under advisement, and an average client size of 1.2 million. So here, we just wanted to give you a little bit of a sense of the growth rate for these CEFEX firms. As you can see, the 1 year period between 2018 and 19, the growth rate for the CEFEX firms was about 12% versus a -6 for the S&P 500. Over the preceding 2 1-year periods, you see that these CEFEX firms grew at roughly 20% versus 10 and 19% for the S&P 500. And growth rate over the 3-year period in aggregate was about 13% versus 8% on the S&P 500. So now let's dive into some of the practice insights related to investment strategies, products, or key fiduciary topics. We're going to start with social responsive investing, or ESG, which has been a really hot topic over the last few years. We have a practice, Practice 2.7, that examines how the investment due diligence process that these firms are using relates to environmental, social, and governance factors, and how that's conforming to the specific fiduciary obligations of the decision makers. So, as many of you know, the advisors and firms have really been struggling with balancing fiduciary obligations on one hand, related to the economic interest of the investor, versus the non-economic interest of the client on the other hand. And companies, and there's a lot of talk that also investment companies or advisors that don't take environmental factors or social impact into consideration may not be demonstrating good governance topics. So it's one of the areas that we track from an adherence to the fiduciary practices, but also a really important trend. And here, you can see that those advisory firms that are recommending SRI or ESG strategies is about 14%. We saw this rise from about 10% last year or in 2018. So the next topic is related to investment annuity or annuity investment practices or products. Here again, this relates to us ensuring that there is some type of due diligence process for making recommendations as it relates to annuity or insurance products. So here, what we do is we want to make sure that advisors demonstrate as they take a look at these products that the fees and expenses are reasonable and they have some mechanism for doing that type of evaluation and examination, from a reasonableness perspective, that they also are taking a look at other evaluation factors, such as, the tax implications, the overall product structure, what's the client's preferences for guaranteed income. And here, about 18% of the advisors recommended annuity or insurance product. And this is pretty consistent with the previous report that we published. So here's some data and some information on alternative investments. Our practice 3.3 focuses on decision making or the decision making process related to investment strategies and types of investments. And so here, the key message is that as advisors are looking at and doing due diligence on alternative investments or alternative vehicles, that the by the very nature of these vehicles and the complexity, that they require some really special analytical skills and due diligence that needs to be a part of the process to, in fact, make sure that you're meeting or fulfilling that obligation of care, especially given that these products typically aren't regulated. Transparency is really hard to get insight to a lot of these vehicles, and they're not easily valued. As you can see, about 12% of the CEFEX firms are recommending the alternative products or alternative vehicles. Here again, not much of a change versus what we saw in the previous report. Um, in terms of one of the areas that are a part of the overall practice examination process is this idea or the practice of periodic reviews and making sure that those performance reports and reviews are appropriately comparing both market and peer group benchmarks. And this is part of our practice 4.5. As part of our assessment process, we typically take a look at a sampling of the client portfolios and the process, due diligence process and reporting process that the advisory firms are using and run them through our FI360 mutual fund and ETF analyzer. The overall goal here is to make sure that the tools that are being used by the advisory firm is in line with their published scoring or their internal scoring and evaluation process. So here, the FI360 score, takes a look at track record, assets of the under management or under advisement of the investment manager, manager tenure, a number of those key factors. And as you can see here, we within our scoring methodology, we score funds from 0 to 100, 0 being good, 100 being a negative or a score that's in the fourth quartile. And the fourth quartile score is that above 75. And on this particular chart, what we're showing is that less than 1% of the advisors that we examine this process have portfolios or investment managers that potentially are on watch list or underperforming. And why this is so incredibly important as part of the process is that all of you know that having poor performing investments in a portfolio potentially could lead to arbitration or litigation risk. And so this whole process of, making sure and doing an independent assessment of potentially poor performing investments is an important part of our overall assessment process. The next topic is related to the use of no transaction mutual funds in client accounts. So here, we take a look at when a plan or in an IRA, the assets that are held by the custodian are using or recommending either transaction fee mutual funds or non-transaction fee mutual funds. Within retirement plans, our view is that this is a fiduciary due diligence act. Within IRA accounts, we view this whole evaluation process as a best interest act. And so here we really encourage, advisors have a prudent practice or a process for evaluating when they would use transaction fee versus non-transaction fee accounts. And the non-transaction fee accounts typically have lower expense ratios on an ongoing basis, whereas transaction fee funds, have the initial cost, but, potentially may be lower cost on an ongoing basis. As you can see here, as part of that evaluation process, about 56% of the certified advisors are using non-transaction funds or deem them to be in the best interest of clients within IRA accounts or retirement accounts. The next topic that I wanted to cover relates to the debate between active versus passive investment strategies. And here again, we have a practice that wants to make sure that there is some rationale that the advisor, the firm is going through in terms of determining, which is most appropriate for their clients are the merits of passive versus active strategies. Here again, the age-old debate around active managers seeking additional alpha or additional return versus the low cost of index investing. And what we're looking for here is, again, that there's just some documentation around the recommendation process. Most of the practices that we looked at, roughly 70%, use both active and passive. We do have some international advisory practices that we look at as part of our assessment process. And one of the things that we observed there is a higher usage of passive in international markets, to the tune of 77% of the practices that we looked at have exclusive passive mandates. So we thought that that was kind of interesting. Again, sort of the difference between sort of a mix or hybrid around U.S. advisors or advisory firms versus international firms. The next topic that I wanted to cover is related specifically to target date fund utilization, and specifically for defined contribution plans. We have a criteria that takes a look at pre-diversified investment options or target date funds, and making sure that there is reasonableness and assessment around risk and return assumptions. And so here, it's a really important, that the fiduciary understands the principal strategies or risks that are associated with these funds. And we're taking a look at the underlying investments and asset classes that are being utilized within these funds. It's important that they have some documentation around glide path, and really looking at and examining that guide path, and where the most conservative allocation will be hit as part of that glide path. 2/3 of the advisors are using target date funds as part of their recommendations. We wanted to do a little bit more of a deep dive here, because we know so much attention and the level of assets going into target date funds is massive. And so here we wanted to provide you with a little bit more information of the CEFEX firms that we took a look at. 59% use both to and through funds as part of their recommendations and evaluation process. About 30% only use through, and 8% exclusively use to funds. But I also wanted to share and give you some insight around these specific criteria that is being used by the advisory practices when they take a look at target date funds. And I just wanted to highlight the first two. Our first four criteria here. 76% evaluate expenses of the manager and sub-managers to make sure that and determine reasonableness of those fees. So that's the number one criteria that's being used. Number two is they take a look at the actual fund structure. And so looking at mutual funds versus collective trust structures, which have been gaining momentum in the marketplace. Another area that has received a lot of scrutiny and attention in this second criteria is taking a look and evaluating the appropriateness of different asset classes. The third criteria relates to the effectiveness of participant communications and education materials, and a little more than half use and do some level of review around proprietary versus non-proprietary usage within the target date funds. Here again, what we're starting to see is more usage of non-proprietary as well as usage of model portfolios here in the evaluation of target date funds. Here's some thoughts around an area that a lot of advisory firms are beginning to participate more actively in, as well as broker-dealer firms or large IRA firms that we work with are beginning to put some more structure around in terms of allowing advisors to more actively participate as 338 investment managers. And here, the role of 338 advisors or investment managers is for them to take more discretion in terms of oversight around the specific investment strategies, whether they be mutual funds or sub-advised managers, stocks, bonds, etc. But here again, what we're looking for is that the advisors or the firms that are acting as 338s, that they have sound due diligence structure and practices in place, procedures in place for them acting in this really important capacity. And we've seen significant growth of advisory firms, broker dealers acting in this capacity or having access to product solutions for advisors to act in this capacity. And we anticipate that to continue to grow in the future. As you can see here, 72% of firms have that as a part of their product offering or solutions offering. Here we asked advisory firms their capacity or their usage around investment advisory products, such as Robo. And here we still see little adoption of advisory firms making available, robo type of advisory solutions. Only about 10% have that as part of their product offering during our last review. Here, what you are looking at is, the model portfolio, and we define model portfolios as providing advice, let's say, for target date funds or risk-based funds, or in some instances, advisors that are working with retirement plans and in some wealth advisory accounts will also do and provide advice on the managed account as well. Here again, we're starting to see some growth in terms of advisory firms offering model portfolios as part of their offering. More than half of the advisors are making a solution like this available to their clients. And here we wanted to get into and provide you some information around formal proxy voting as part of the overall process. And as you can see, about 90% or 89% actually have some type of conversation with their clients around proxy authorization and delegation of voting to investment managers. The really interesting thing here, though, is that conversation being translated into a formal policy that is written and documented is less than half at 45%. And then those advisors and clients that actually have a log for recording proxy voting is right around 19%. So we need to continue to see additional work as it relates to proxy structures and fiduciary documentation there. So the next area that I wanted to do a little bit of a deep dive in is related to the security process here. And we actually have and spend a lot of time as part of our due diligence process looking at documentation as it relates to the making sure that the appropriate processes and procedures are in place to protect the privacy of client or plan data. And what we are looking for as part of these written policies and procedures and making sure that they're really reasonably designed, and we really focus on three areas. One, that the policy ensures security, confidentiality of the customer records and information. Two, that it protects against any anticipated threats or hazards to security or integrity of the customer records. Three, that it protects against unauthorized access to the customer records as well. And these are all yes responses to the various questions that are part of the assessment process. I just wanted to bring a few of the assessment questions from a trending perspective and highlight a few of those. Here you can see stored personal identified information, PII, in graph one is going down, so that's a good trend from 78 to 70%. And the one area that had a little bit of a negative decrease was encryption at the email level in graph number 6. You see that went down a little bit from 93% to 88%. Now we're going to switch to some practice management insights. Here you can see there's been a major shift of moving client information and documentation from paper or residing with clients to online vaults. You can see 90 or 89% of the advisors offer client vaults available. Here, you can see only about 20% of the firms that we talked to had been subject to a SEC or state examination. So that gives you a little bit of insight of the regulatory examination stats. Another really hot topic is policies and procedures and practices that are in place for a real challenge in the marketplace. And this is, working with and dealing with older clients. And the good news is that most of the practices that we did assessments on have policies, procedures, and practices in place for working with clients with diminishing financial capacity. 77% we observed in our assessments there. In terms of rollover advice, this is an area that has received a lot of attention given the focus on here again, making sure that there's policies and procedures that are part of the advice and recommendation and being able to meet the best interest standard. And so we observed, 58% of the practices that we took a look at that they had really strong documentation that was a part of that advice and recommendation process. Cybersecurity, this is no surprise that given the risk associated with cybersecurity issues, that a number of the advisory firms and organizations have looked to the insurance industry to help mitigate part of that risk. And so 80% of the organizations are specifically carrying cyber security insurance. And with that, let me see if there are any questions before I wrap up. Okay. Okay. All right. I'll have some closing comments. I don't see any questions here, but in terms of how Broadridge Fi360 can help members of the IAA, there's really three areas that we really believe that we can help. In addition to the certifications that I've been talking about, within Broadridge Fi360 Solutions, we offer training around fiduciary best practices and prudent practices through our accredited investment fiduciary training and designation. And we believe that this is really important for the membership, because what we've heard is that home offices and compliance professionals and advisors that have gone through this training really, again, sort of helps mitigates some of the potential challenges that they may run into as it relates to arbitration or litigation risk. And so really having a nice grounding in fiduciary practices and principles, even if you are not acting as a fiduciary in that specific client engagement. Again, we've seen that have a really nice positive impact for those organizations. Second is software. We offer software and analytical tools that really help document and support the fiduciary process in a really efficient way. One of those tools is our fiduciary focused toolkit. And here again, it helps really provide some structure and oversight to what your advisors or agents are using as they engage with clients, and really helps reduce liability and risk, and help those organizations win business. And then lastly, is data and analytics. Here, the tool that I want to highlight, or service that I want to highlight, is business intelligence. And here, this provides a level of oversight for retirement business and advisory business at the aggregate level. So I am almost just about out of time, but I really want to thank you for joining this particular session. And if you have any questions, you can email us at the website as on the screen, as well as join our virtual booth. So again, thank you so much, and enjoy the rest of the conference.